After earning $3 billion from gold, one Chinese trader made a move that confused the market and unsettled those who thought the cycle was already understood. He didn't announce it, he didn't explain it, and he didn't rush. Because when someone who mastered gold starts turning his attention toward silver, it is never about excitement. It is about what comes after confidence fades. This was not a reaction to news. It was a response to pressure building quietly beneath the system. And by the time the wider market notices the shift, the real opportunity may already be gone. Welcome to Boring Currency Index. If you've lived long enough to see currencies lose value, to watch promises change, and to learn that markets repeat the same mistakes in new forms, then this channel is built for you. Subscribe, not for noise or drama, but to stay aware while others stay comfortable. And tell us in the comments, from where in the world are you watching these changes unfold? He was never a public figure. No interviews, no headlines, no personal brand. Yet inside commodity circles, his decisions were followed closely. For years, his focus remained fixed on gold, not as a symbol of wealth, but as a measure of stress. He believed gold reflected what policymakers avoided saying out loud. When money was created faster than value, gold responded. When debt expanded quietly, gold signaled early. He didn't chase price. He studied behavior, central bank balance sheets, real interest rates, long-term currency trends. While others traded short-term movements, he positioned for cycles. Over time, this discipline turned patience into nearly $3 billion in profit. The exits were controlled, the timing deliberate. But instead of celebrating the success, he questioned it. When gold became popular, discussed openly, promoted heavily, and crowded with late capital, he saw risk, not safety. Popular trades attract attention. Attention attracts interference. That's when he looked elsewhere. Silver appeared calm, too calm. Its price had not reflected its changing role in the world. No longer just a precious metal, silver had become critical to industry, energy systems, electronics, medical technology. Demand was growing, but recognition was not. More importantly, supply was tightening. Unlike gold, silver was being used up. To him, this imbalance mattered more than forecasts, so he began shifting quietly, step by step, without noise, not chasing returns, but preparing for what markets usually ignore until adjustment becomes unavoidable. Most traders watch the news, but the smart ones watch the money. They understand that markets move long before the story hits the headlines. And while everyone was debating inflation numbers, one trader was tracking where capital was quietly flowing. He wasn't looking for excitement. He was looking for pressure building beneath the surface, and he found it in silver. Here's why. Governments worldwide are spending more than they're making, turning massive debt into permanent policy. To keep this going, interest rates are suppressed, which means our money loses value over time. Gold has already priced this in. But silver? It's been lagging. What makes silver unique is its dual personality. It's both money and a critical industrial material. This means it reacts to financial stress and industrial demand. When both of those forces pull in the same direction, the price doesn't just climb, it explodes. History shows that in every major monetary shift, silver moves late, but it moves fast and sharp. With governments now securing strategic materials, silver's industrial importance is becoming a national priority. The quiet signals are getting louder. Thanks for watching. Mining data reinforced his view. New silver discoveries were declining. Many silver mines depended on byproduct production from other metals. This limited the ability to increase supply quickly, even if prices rose. Demand, however, could rise without warning. This imbalance concerned him. Rather than placing large, visible trades, he used layered accumulation. Physical silver, long-term contracts, exposure tied to production rather than speculation. Each position was designed to avoid attention and reduce risk. To outsiders, nothing appeared unusual, but inside his models, stress indicators were aligning. Currency volatility, rising energy costs, growing reliance on fiscal support. These were not isolated problems. They were connected signals of a system losing flexibility. Silver, in his view, was not undervalued because the market was blind. It was undervalued because the market was early. And when markets finally recognize a problem, they rarely move slowly. This phase of preparation was not meant to generate headlines. It was meant to survive what came next. Because once confidence breaks, liquidity disappears first, and assets tied to real-world function are repriced without warning. By this stage, his strategy was no longer about opportunity. It was about risk management. He observed that global markets were becoming increasingly dependent on confidence rather than fundamentals. Asset prices remained high, not because productivity improved, but because liquidity was constant. When liquidity becomes policy, small shocks can produce large reactions. This is where silver gained a different meaning. Unlike financial assets, silver could not be created by policy decisions. It required time, energy, labor, and stable supply chains. Yet the world was moving toward instability in each of those areas. Energy prices were volatile, labor costs were rising. Political friction was increasing between major producers and consumers. In such conditions, paper assets depend on trust. Physical resources depend on reality. He paid close attention to futures markets. Paper claims on silver far exceeded the amount available for delivery. This structure functioned only as long as most participants never asked for the metal itself. The system relied on settlement, not possession. That imbalance disturbed him. At the same time, industrial users were locking in long-term supply agreements. Solar manufacturers, electronics producers, and battery developers were securing access years in advance. They were not speculating, they were preparing. This behavior sent a clear signal. Risk was slowly moving away from those holding promises and toward those controlling material. He adjusted again. Some exposure was shifted out of financial instruments and into custody-based holdings. Storage mattered. Jurisdiction mattered. Accessibility mattered. These decisions did not increase short-term returns, but they reduced dependence on market functioning during stress. His models showed that if even a small percentage of paper-silver claims turned into physical demand, pricing mechanisms would fail temporarily. Spreads would widen. Delivery delays would appear. Volatility would increase sharply. This was not a forecast of collapse. It was a forecast of disorder. Disorder is where markets reprice risk quickly. He did not expect governments to announce a crisis. He expected them to manage perception, stabilize headlines, and maintain calm. But real constraints do not respond to communication strategies. When trust weakens quietly, preparation matters more than reaction. By now, silver was no longer just a position in his portfolio. It was a hedge against system behavior. The trade did not rely on perfect timing. It relied on structural imbalance. And history showed that when imbalance persists long enough, the adjustment phase is rarely gentle. Those waiting for confirmation often arrive late. Those positioned early rarely need explanation. The final stage of this strategy would depend on one thing only: how long confidence could hold before reality forced its hand. By the final phase of his strategy, the trader was no longer focused on price targets. He was watching behavior. Markets, in his experience, reveal stress not through numbers first, but through reactions. Small disruptions were now producing outsized responses. Minor policy comments moved currencies sharply. Supply warnings caused immediate repricing. Volatility was no longer an exception. It was becoming normal. This was the environment he had prepared for. Silver began to show signs of strain, not dramatic spikes, but persistent tightness. Delivery times lengthened. Premiums increased quietly. Industrial buyers accepted higher costs without hesitation, a sign that availability mattered more than price. To him, this confirmed the thesis. Gold continued to act as a warning light for the system. But silver was becoming the pressure point. Its role in energy transition, technology, and infrastructure made it unavoidable. Unlike financial assets, it could not be replaced easily or delayed without consequence. At the same time, monetary authorities faced narrowing options. Raising rates risked debt instability, cutting rates weakened currencies further. Maintaining balance required intervention, and intervention required credibility. Credibility, once questioned, is difficult to restore. He did not expect a single event to trigger change. He expected a sequence of small stresses, each manageable alone but powerful together. In such conditions, markets often reprice assets not based on forecasts, but on necessity. Silver fit that category. His final adjustment was defensive. Positions were secured. Exposure was balanced. Liquidity was preserved. This was not an aggressive stance. It was a posture designed to endure uncertainty rather than exploit it. The lesson behind the strategy was simple but uncomfortable. Most investors react to outcomes. He positioned for constraints. When systems rely on confidence, physical limits matter more than narratives. When trust weakens, assets tied to real function gain relevance quickly. And when recognition arrives late, repricing is rarely gradual. Silver was not a guarantee of profit. It was a reflection of imbalance. By the time broader markets began asking why silver mattered, the answer would already be visible in supply chains, in pricing behavior, and in policy responses that felt increasingly urgent. The trade itself was never the message. The message was the warning behind it. When experienced capital moves quietly, it is often responding to risks that have not yet been named.